Welcome back, traders. In this video, we will go through this secret entry model, allowing you to take higher quality trades with confidence and avoid unnecessary losses. You'll also learn how to maximize your risk to reward ratios so you can make more profit per trade. Most importantly, you'll be building a solid foundation for consistent and successful trading. Without further ado, let's get into the video. There are two scenarios when using this model. In the bullish setup, price initially forms a series of lower highs and lower lows, showing clear bearish pressure. Then, we wait for a change of character, where price breaks structure to the upside, signaling a shift in momentum. Once this shift is confirmed, we place a limit order at the newly formed bullish order block with a tight stop loss below the block. When the trade reaches a 1-2 risk to reward ratio, we move the stop loss to break even to eliminate risk. For take profit, we target the previous buy-side liquidity, where stop losses and breakout orders are likely resting. In the bearish scenario, the opposite applies. Price starts by printing higher highs and higher lows, indicating bullish control. Then, a change of character occurs when price breaks a key low, signaling a possible trend reversal. We then place a limit sell order at the newly formed bearish order block, with a tight stop loss just above the block. Once price hits the 1-2 risk to reward ratio, we again move the stop loss to break even to protect capital. The final target in this case is the previous sell side liquidity, where we expect the market to draw toward and complete the move. A powerful extension of confirmation-based entries is when they are paired with a liquidity grab. Before the market gives us a structure shift, it will often sweep liquidity, such as equal highs or equal lows, to trap early traders and trigger stop losses. This sweep clears out weaker hands and activates institutional orders sitting above or below those levels. After this liquidity is collected, we then wait for the confirmation shift in structure. This is where the entry model comes in. We place a limit order at the new order block formed after the shift. A tight stop loss is placed just outside the block, and again, we aim for a 1-2 risk to reward ratio, moving the stop loss to break even once that level is reached. For take profit, we target liquidity levels, buy side for longs and sell side for shorts, which are common points of interest for price to reach. Now that you understand how the model works and how liquidity plays a role, let's walk through how to apply this strategy step by step. First, begin by analyzing the 15-minute market structure to determine whether the overall environment is bullish or bearish. This gives you directional bias and helps you avoid trading against the trend. Next, move to step 2. Identify high probability order blocks. These are key price zones, either bullish or bearish, where the market is likely to react, often formed after a strong move or a break in structure. Finally, in step 3, apply the entry model that we just learned on the 1-minute time frame. This ensures you're trading with confirmation, not anticipation, helping you take higher quality setups with confidence. Enough of the boring theory. Let's dive into some real chart analysis on the euro-dollar pair. On the 15-minute time frame, we can clearly identify a strong uptrend marked by a series of higher highs and higher lows, which signals solid buying momentum. Each time the price breaks structure to the upside, it leaves behind strong structural lows that reinforce the bullish direction. As the market pushes higher, it forms weak highs, temporary resistance levels that are likely to be broken. Once one of these weak highs is taken out, a new strong low is established, confirming the continuation of the uptrend. This pattern continues, with every retracement failing to break the previous strong low, leading to the formation of another weak high. However, recently we saw a sharp price drop that swept liquidity from a previous strong low and nearby order blocks, leaving behind a large wick, an important sign of institutional activity. Also, price retested a key level and showed a strong rejection, which could indicate a potential reversal. Now that we have a solid confluence on the 15-minute chart, let's drop down to the 1-minute time frame to refine our entry. Then, we can see that the internal trend is bearish, marked by a series of lower highs. For our entry, we need to wait for a clear shift in structure, specifically a break above the most recent lower high. Once that happens, we identify a strong bullish order block and place a buy limit order at that zone. The stop loss goes just below the order block, and our target is set at the previous buy-side liquidity level. Alternatively, for a liquidity grab entry, we look for equal lows to form, followed by a clean sweep of that liquidity. After the sweep, we locate the most relevant bullish order block and place a buy limit order there, again setting the stop loss below the block and targeting the previous buy side liquidity. As the price unfolds, it breaks structure and forms equal lows, followed by a clear sweep, signaling a high probability buy setup. At this point, we can spot two high probability order blocks. So, we place two separate buy limit orders at each zone, with stop losses below the respective blocks and take profit levels targeting the previous bearish order block. As price reaches a 1 to 2 risk reward ratio, make sure to move your stop losses to break even to protect capital. Eventually, this trade hit take profit for a total return of 1 to 4 risk reward ratio, an example of a textbook execution. Let's take a look at another example. On the 15-minute time frame, we can clearly observe a strong downtrend defined by a sequence of lower highs and lower lows, indicating consistent selling pressure. With each break of structure to the downside, the market leaves behind strong structural highs that act as key resistance zones, further confirming the bearish direction. As price continues to drop, it creates weak lows, temporary support levels that are likely to be taken out. When one of these weak lows is broken, a new strong high forms, reinforcing the continuation of the downtrend. This bearish structure holds, with each pullback failing to breach the previous strong high, leading to the formation of new weak lows that are primed for liquidity grabs. In addition, we notice the presence of a significant rejection block, and price eventually retraces to retest this area. Now that we have strong confluence on the 15-minute chart, it's time to drop down to the 1-minute time frame to refine our entry. Next, we observe that the internal structure is bullish, characterized by a series of higher lows. To execute our entry, we wait for a clear internal shift, ideally a break beneath the most recent higher low. Once this occurs, we pinpoint a strong bearish order block and set a sell limit order within that zone. The stop loss is positioned just above the order block, while the take profit targets the nearest area of sell side liquidity. Alternatively, for a liquidity sweep setup, we wait for the market to form equal highs, followed by a decisive sweep of that level. After the liquidity is taken, we identify a key bearish order block and place a sell limit order accordingly. Again, we place the stop loss above the zone and aim for the previous sell side liquidity as our target. As the price unfolds, it breaks structure to the downside. At this point, we identify a high probability bearish order block, prompting us to place a sell limit at that zone with the stop loss just above the block and take profit targeting the previous bullish order block. However, this initial trade gets stopped out for a 1% loss. Interestingly, right after triggering our stop loss, price sweeps that level and continues downward, forming another change of character, further confirming bearish intent. Given the recent loss, it's important to stay disciplined, so we wait patiently for equal highs to form, followed by a clean liquidity sweep before considering another entry. Once that liquidity grab occurs, we get our green light. We place a new sell limit order at the fresh order block with the stop loss above the block and the take profit aimed once again at the previous bullish order block. As price reaches a 1 to 2 risk reward ratio, we move our stop loss to break even to secure the trade. Eventually, the position hits take profit, delivering a massive 1 to 8 return. Despite the first trade being a loss, the second one more than makes up for it, bringing us a total gain of 7% across both trades, an excellent example of how proper risk management and patience can lead to solid profits, even after a setback. That wraps up today's video about this 1-minute entry model. Be sure to check out other videos in our Smart Money Scalping series. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you never miss out on our latest trading strategies and insights. Thanks for watching, and I'll see you in the next episode.